Hello, welcome to the Economic View today. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Evan, we have to talk about what's happening with Turkey and the Aussie dollar, why it's happening, and really, is this going to be a long-lasting thing? What's next? I mean, there's a lot of talk about contagion flowing into other countries as well. So let's start at the beginning. What's caused all this? And why is it flowing through to our dollar and, of course, other currencies?
So yeah, very broad questions. Let's look structurally. Let's have a look at Turkey, a country that we don't really need to worry about in terms of what it actually means individually. So Turkey has, as we know, a president that is fairly similar to the US president in the fact that he's quite a strong man, Erdogan.
Sort of.
Yeah. He is starting to do a bit of nepotism, so he's put in his son-in-law into the finance ministry at the start of the year. A few other bits and pieces that have done. He's also, and this is what's really interesting from an economic and sort of macro perspective, is he describes interest rate hikes as the mother and father of evil. So he's almost basically told their central bank that you can't raise rates. Now, all that's part of it. So then you've also got to look at the country itself. It has 15.5% inflation and growing at a rapid rate. It doesn't have any real major checks and balances on its taxation system. So one way to slow this down would be to actually increase taxes to therefore get their structural deficit under play. And I'll come to that in a sec. And then you, as I said, you don't have a central bank that's allowed to raise interest rates. So you've got this run-on effect. So all of this is sort of filling out. Now, the contagion issue and part of the contagion question is that it's what's going on with Turkey and its relation to Europe is quite interesting. Turkey for a long, long time has been trying to get into the European Union. It's been taking a huge amount of steps to try and get all the checks and balances in place for what Brussels needs. But during that period, most European banks have been basically doing business inside Turkey. So I've got a chart to show you here on screen. This is the actual amount of exposure that European banks have into Turkey. So Spain, as you can see, it's just shy of 80 billion. You've got France just shy of 40 billion, and then you've got Italy that's just shy of 20. So it's about 18. So there is some big exposure into Turkey. Now, the other side of the equation and why this is happening so fast is that emerging markets, and we'll come to that in a minute as well, emerging markets, particularly the BRICS, so that's Brazil, Russia, India, China, and South Africa, along with Turkey, have had quite high interest rates on their sovereign bonds over the last 10 years. Now, with what's happened post the GFC, your places like your ECB and your Fed have been giving you basically money for nothing. They've cut rates to zero with the Federal Reserve over that period. The European Central Bank also basically cut their rates to zero. So you've got European and US investors that can borrow money for basically nothing and then take it and put it into a high earning space. So they have put it into emerging markets. It's why places like South Africa and places like Turkey have done well with capital inflow, because all this money that's been washing through global markets has ended up there. But all of a sudden you've now got structural issues with the country, tightening monetary policy in the US, and that money is now flowing out. So the chart on screen, as I'm sure you're all aware, has been, this is the US dollar to the Turkish lira. Now what this means, although this chart's showing an appreciation, it's actually showing the Turkish lira falling. So for every $1 US, you at the start of the week were getting 7, which was a record low in the Turkish lira. 7 Turkish lira to $1 US. It's dropped off a little bit, but this is a big capital outflow. This is a huge, huge depreciation in the currency. It's down almost 57% year to date, and it is the worst performing currency around.
Going right back to the very beginning, I mean, a lot of this is around geopolitics. So obviously, there's a lot of strain between Turkey and the US at the moment on that level. Turkey is definitely leaning more towards Russia and Iran. They've detained a US pastor, and that sort of brought about these retaliatory tariffs from the US on their steel and aluminium.
Correct.
And that sort of really escalated this whole situation.
I want to pick up on that because that is certainly what the political element is.
Yeah.
But I want to show this tweet from the president. So again, this is a tweet the president put out last Friday that was really inflammatory. And this gets back to your first question about what this means for the Aussie dollar. And it's that middle sentence. So this is his justification for putting 20% and 50% tariffs on Turkish aluminium and steel products. Was to wrap it up, was basically saying that the Turkish lira's decline against their incredibly strong US dollar is their fault. And they are doing that. That is the inferred meaning. Now, what he's basically alluding to is currency wars. Yeah. Right? So that gets back to the next point, which is China. So the US-Chinese trade war if it moves to a currency war, he probably actually somewhat has a legitimate argument. So this week we saw the Chinese yuan at the lowest level since May 2017, and it looks like it's going to head towards 7 Chinese yuan to $1. That is clearly Beijing moving their currency down to probably offset the impact, and we've spoken about this before, of the tariffs. What does that mean from an Australian perspective? Well, we are seen as a quasi-China trade. 37% of our exports go to China, and if you have a look at our exports this year, they're doing incredibly well because China's on the way up with that kind of material. So we are suffering from that. We're also an emerging markets provider. So currencies and countries we don't ever really talk about on this program, places like Malaysia, places like Indonesia, India. This week's been a horror week.
South Africa.
South Africa. And again, the RAN is one to look. In fact, we'll show you the chart we've got now. This is the RAN also having the same problem. It's having a huge run out. It lost around about 8% this week alone. That all comes back to us because we are technically a risk currency, and we are an export of bulk commodity nation. And that is why this does affect us to some extent. What would get really, really interesting, and this is the hypothetical, getting back to that tweet. Yes, he could go at China, and he's probably got a legitimate reason to. The nations that he really quite enjoys sort of pointing out is Europe. Now, we've seen the euro now fall to 1.13, and on that, we know that he is not against singling out a NATO ally, particularly places like Germany. If the euro was to catch a bit of contagion from the Turkish issue and fell to 110, could you imagine if he put a tweet out basically accusing the Europeans of devaluing their currency? That would signal a whole nother movement in geopolitics.
Our currency has been, you could say it's been smashed a bit. Is it going to stay around the current levels? Is it going to come back above 73?
I think markets, unfortunately, in these scenarios always overreact. So there is probably a slow grind back up. There are a few things that are probably going to happen over the next 6 weeks that probably push it that way. Namely, we're going to get our net export numbers over that period. Again, you're going to have the RBA saying that they're not moving in the September month. All of that probably there. Not only that, the US dollar against everything is appreciated, and the US dollar itself will probably just ease off a little bit. So yes, it probably will go back towards 73, but are we going to see it at 74.5 or 75 in the coming future? Probably not, because the other thing that happens next month, and it's more important, getting back to the economics, is the US Federal Reserve will meet for their September meeting. It's a press conference meeting, and they will raise rates by 25 basis points. So that should be a US dollar hold, or at least a strengthener. So the Aussie's ability to go towards 75 cents is probably unlikely. But yes, I agree with you. It'll probably go to 73, maybe a little bit through it. Can't see it going to 74.5 or 75 anytime soon.
Thanks very much, Evan.
Thanks, Tony.
Thanks for joining us on The Economic View.